Could the next financial crisis be in the student loan sector? It might very well be. JP Morgan Chase recently sent out a memorandum to colleges notifying them that the bank will stop making new student loans in October. Well, why is that? Well, according to the chief executive for auto and student loans, we just don't see this as a market that we can significantly grow. Now, what they are really seeing are defaults on student loans, meaning students now graduating are not able to pay back those loans. This means the investment that banks are making into loaning are not coming back in profits. Now, why can't these students afford to pay back their loans? Well, it's due primarily to two things: a lack of job creation and a lack of retirement affordability. Basically, we have a lack of jobs, not just working class jobs, but educated jobs. A ton of these jobs were lost in the 2008 global collapse of capitalism that never returned, meaning kids today are graduating with skills that have nowhere to employ them. Obviously, this leads to them being stuck in dead-end minimum wage jobs with no ability to afford the loan payments, which is usually accompanied by an inability to afford many of the basic living standards as well. Now, this is only half the story. The other half is the fact that older people who are employed are not leaving their jobs when they expect to because of the economic hardship. This means they are staying around working longer than they had anticipated in order to make ends meet. What we have here is too many under and unemployed youth who cannot break into the higher paying levels of employment, or sometimes any employment at all. This is called a youth bulge. A ton of young people who are basically being alienated by society that are becoming increasingly angry. If you're interested in where this leads to, one look no further than the youth riots in Spain, Greece, and Brazil. To see the riots that have been going on there with disenfranchised, excluded youth. Alright, now back to the economics. This closing of student loans is curiously similar to what happened in 2007 as the banks began to close their subprime units. As people were unable to pay back those subprime mortgages, banks stopped making them because they were not profitable. Even the language used is very similar. Here's what HSBC said when they eliminated subprime mortgages in 2007. It's no longer sustainable and not the right place to allocate capital in the future. A question to ask here is, how big of a debt is not being paid back? According to CNBC, the link in the description, there's over $1 trillion in outstanding student loans, making it the second largest source of household debt after mortgages. Now, just 10 years ago, student loans stood at $240 billion. About $150 billion of the total is comprised of private student loans made by banks and other financial institutions, according to a report issued by the Consumer Finance Protection Bureau last year. Now, keep this in mind. The entity with the biggest exposure to student loan defaults is the U.S. government. I'm not saying that there's going to be a huge crash of debt coming at any moment. What I am saying is that what we're seeing is very similar to what we saw in the past with unpaid debts as it relates to subprime mortgages. So, why does this happen? The problem lies in the contradiction between the plan on how much to loan out to the students and the ability of the students to pay it back. This increasing inability to pay back those loans is a quantitative change that can increase into a qualitative change into a crash of the student loan sector. There is a dialectical contradiction here between the needs of profit making of capitalism and the reality of the market. This is, of course, nowhere near the size of the losses in the subprime mortgages, but it is significantly large enough to do some damage to the financial industry. This could be enough to spark another recession, which would be devastating given how poorly we came out of the last one. Only time will tell for sure.